Hello everybody and welcome to my guide about how I trade the stock market successfully. In this DVD we will be going over my entire strategy that I have mastered over the past 6 years. There's a vast amount of different trading styles out there that people have used successfully to make money in the stock market. But every trader needs to find their own niche in the market that they feel comfortable with. It is my goal to teach you my niche on the market so that you can begin your career or new hobby as a profitable stock trader. This niche that I speak of is called the Foos 4. Okay, so first I need to brief you quickly on the disclaimer of this DVD. Note that I am not a professionally licensed financial advisor or stockbroker, so everything I say in this DVD is strictly for educational purposes only, and I nor the Technical Trader LLC is held liable for any risks or losses that you may take in the stock market. This DVD is not to be considered advice on what stocks to buy or sell. It is simply an overview of how I personally approach the stock market. Also take note that past performance is not an indicator of future performance, and trading the stock market can be a very risky investment of your time and money, of which may result in losses. It is highly recommended that you take any knowledge that you gain from this DVD as a starting point and seek professional advice before making any investments. So first off, my name is Cameron Foos, and I was born and raised in the way too liberal of a town called Eugene, Oregon. Growing up, a lot of people are lost about what they want to do for their career, but ever since about 7th grade, I knew I wanted to be a stockbroker. My best friend's dad was a stockbroker, and my parents' good friend was also our stockbroker, so it seemed like they did pretty well for themselves, and the concept of the stock market was always fascinating to me. Yet it wasn't until I was in college when I got the real itch to get involved with the market. Now, this whole time that I'm in college, I'm thinking I'm going to graduate and go work for some firm. The thought of being an independent trader and running a business where I'm sharing my trades and educating people along the way never once crossed my mind. It wasn't until 2005 when I opened up a trading account and became a member of a website called 3stocksonfire.com. This was a site that pretty much does the exact same thing I do today at my website and with the Black Service Real-Time Trade Alert service. So here I was back in 2005. I didn't know what the hell I was doing, but I was absolutely addicted to the stock market, and I thought the people that ran this 3stocksonfire.com website were cool as hell. I basically wanted to be them. There are actually two traders that lived in Portugal and traded stocks on the US exchanges. These guys were smart traders and actually based a lot of what my strategy is now off of what I learned from them back in 2005. Now, of course, I've learned a lot since then and made some tweaks, but my trading foundation was definitely built from 3stocksonfire.com in my first year of trading. The foundation that I built was a strategy on how to swing trade small cap stocks that were breaking out to new recent highs on volume, in which I then hold the stocks for a couple days to several weeks in return for hopefully profiting. The key to this strategy is recognizing the right stock chart patterns and being able to trade them successfully. So after about a year as a member of 3stocksonfire.com, I began to notice I was a very well-respected member in the forums, and I felt like I had even jumped ahead of the guys that ran the website by being able to pick the right stocks at the right time. Now obviously this was a little naive as I had only been trading for about a year, but I thought to myself, maybe I could do this. Maybe I could make a career out of doing the exact same thing that these guys are doing. The problem was, I felt like I was just a kid nobody at 21 years old, only 1 year experience in the markets, so who the hell is going to pay me for stock picks and access to my website? So just to ease my way into the business, I started the technicaltrader.net in 2006 as a way to start building my foundation and build up my reputation on the internet as a dominant stock picker. So I set up my website almost identical to 3stocksonfire.com, yet of course my website was free, whereas 3stocksonfire.com was $50 per month. Slowly but surely, I began gaining a lot of recognition with my ability to pick stocks that would return huge gains in a very short amount of time after I called them. For example, let's take a look at one of my old members who knew me from 3stocksonfire.com and gave a review of my website at feedthebull.com, as well as another member from 2008. You can verify these reviews and look at many more by following this link. So this is back in 2007, 511. So Rob H. said, I've followed Foos' picks and due diligence ever since receiving an email from him at 3stocksonfire.com that he was starting his own site, and am amazed at the insight, accuracy, and detail that he provides week in and week out. It has been a privilege to watch his work, and I can't wait for his results when he finishes his education and dedicates himself to the craft full time. Then another one from 2008. This is quite some time ago. It's now just about pushing 2011. The New Year's on Friday. But here's another one from 2008. So this guy said, Brian Barrow, BBTS S001. I've been a member of TTT.net for about a year and a half. My portfolio has increased more than I could ever have imagined. Not only have I made money, I learned a lot just from using some of Cameron Foos's ideas when it comes to trading and some of the psychology behind the market. Anyways, I love this site. So, these are just some old reviews just showing that I had built recognition from 3stocksonfire.com, and these guys recognized me and saw my talent as I moved into the technicaltrader.net. So I ran the technicaltrader.net for 2 years for free with a solid track record until I was a senior in college. By this time, I absolutely did not give a rat's ass about school. I maybe went to 25% of my classes and would just go over my class PowerPoints before the tests and be able to pull, B to C plus grades. I knew then that trading the stock market and turning the technicaltrader.net into a profitable business was what I wanted to do for my career. So it was now the end of my 4th year in college at Oregon State University, and I came up with a really bright idea. Let's drop out of school and move to Boise, Idaho. I know what you're thinking, like, really? First off, why the hell did you drop out of school your senior year? And second, why the hell did you move to Boise, Idaho? Well, those are both really good questions. First off, school is stupid and a waste of money for certain people, and a college degree doesn't even mean that much anymore. It's about who you know and what you know that will get you places in this new world that we live in. And on top of that, I was a business finance major, and I didn't learn one thing in college that taught me anything beneficial to me about what I do for today in a career in the stock market and finance. Now, I'm not saying to drop out of college by any means whatsoever. I did so because I had something good going for me and I had a plan. And school was just an irrelevant obstacle in my way that I didn't need to go through to get started in my career. Second, I moved to Boise, Idaho because my cousin lived there and I just wanted to get the hell out of Oregon. So here I am in Boise, Idaho, and I'm actually working nights downtown as a bartender at the Main Street Bistro on 6th Street, if you've ever been there. And I'm with my cousin, and I'm about 22 years old now, trading and still running my business for free. It wasn't until April of 2008 when I finally started what's known today as Black Service. I finally got the balls to start charging people to hear about what stocks I was trading myself at my website. And let me tell you, this was the best decision I ever made. In reality, I could have been charging people the whole time I was in college, and I should have been. The market was on fire those years from 2006 to early 2008. So anyways, long story short, Black Service raked in over $30,000 that April from people subscribing to my new paid service. My jaw dropped as I was stunned how many people signed up, as I had about 200 people from across the world who were willing to pay me to be a member of my website and continue to see what stocks I had in store for them. This was one of the most exciting months and years of my life. I was 23 years old, and my career as a trader/business owner had officially begun, and it started out with a bang. But now moving to present day, I reside in sunny San Diego, California, where I live on the beach, trade stocks, and manage the Black Service portfolio at my website. So since 2006, the Black Service portfolio has returned over 6,000% as we are coming into the close of 2010 from the stock picks that I have made with real-time trade alerts to the members who are subscribers. I'm also happy to say that after years of being in business, my website has more 5-star reviews from real members than any other paid stock alert website listed at investimonials.com as of current day. If you don't know what Investimonials is, it's a website where users can go review any finance website, book, or product that they have used. Consider it the Yelp of finance. So while I'm not going to be so cocky as to say I have the best trading website or stock picks on the internet, I will say that I have a solid reputation and have had many happy members over the years that I have been trading stocks. And now finally, after all these years, I'm about to share with you my entire core strategy through this educational DVD. So sit back, relax, and let's learn about trading stocks. And I just noticed my Twitter feed was on there, so I just turned that off. But Twitter's actually a great way to meet new traders online. So you probably saw a couple of the traders that I follow there. So if you wanted to take note of those people. But anyways, moving on to market psychology. I like to call this section a disciplined trader is a happy trader. So I'm going to begin this guide by first digging into trading psychology, simply because it is the single greatest aspect of trading that will lead to your success or failure in the stock market. As you begin trading, you're going to be greatly surprised how important your mental state is to your success as a trader. A successful trader is someone that can control their emotions, remain calm, disciplined, and focused throughout the course of an open trade. As you're sitting here listening to me say this, you may be thinking, okay, cool, I can do that. No problem. But let me tell you, trading is not easy by any means and not for the faint of heart. If trading the stock market was something that just anyone can do, then everyone would be diving into the stock market and we would all be rich. Trading the stock market is a huge mind bender, and it is a living and breathing organism that is ever changing in the process of evolution. What works today may or may not work for tomorrow or the next day. Every day, no matter how experienced of a trader you are, you will be learning something from the continuation of both your successes and failures. In order for you to become a successful trader, you need to be calm, cool, and collect. Someone who is frantic, irrational, and scared is very likely not to be destined to becoming a successful trader. The overall goal in trading psyche is to be confident, defensive, disciplined, and most importantly, emotionless as possible. Rational, clear thinking is key to your success. So soon after you start trading, you're going to either become completely addicted and euphoric, or either super bummed out because the stock market just took all of your money without hesitation. Most people who start trading do so without really knowing what they are doing and end up losing all their money, and that's statistically a fact. Those that actually survive the deadly market will soon realize that the stock market is a completely love-hate relationship. When you make winning trades, you're going to feel complete euphoria, and all you want to do is tell your friends about the money you just made in the stock market today and how easy it was. Then there's the dark, gloomy days where everything is going against you and you're watching your money disappear from your account. You're irritated, you have an empty feeling in your stomach, and you really don't feel like telling anybody about your day in the stock market. You become discouraged and wonder what you did wrong, or more likely, you wonder why the hell you made the stupid decisions that you did. But this is just all part of the game. Overall, if you become active in the stock market, you'll find that it is extremely amusing and really even become more of a hobby than anything. Although, of course, the ultimate goal and motive is to make money. For me, the stock market is a complete addiction, especially since my career and survival in life depends on it. I live and breathe the stock market. I hate when a holiday closes the stock market, preventing me from trying to make money that day. I go to sleep every night, anxious to wake up the next morning, anticipating what the stock market has in store for me. And as most people dread the beginning of the work week, I'm excited and looking forward to Monday to begin. Don't get me wrong, I'm a huge party animal and love my weekends. Let's get that fact straight. But I'm proud and very happy to say I love what I do. As many have to settle for the typical 9 to 5er sitting at a desk living paycheck to paycheck, as an independent trader, I'm free to trade if, when, and where I want. I lived in 3 different states in the past 4 years, traveling the West Coast, running the technicaltrader.net, bartending, and meeting new friends along the way. So it's a very open and free lifestyle that I very much enjoy. Now, although trading can certainly be fun, be aware that stress definitely comes with the territory. When you got your money on the line, it can definitely make things difficult to cope with emotionally. I try my hardest not to get stressed out, but hey, I'm human too. I'm not a robot as much as I try to be sometimes when it comes to trading. It's human nature to feel emotion. I'm sure you've heard that being a stockbroker, financial advisor, or trader is a pretty stressful gig, and you're damn right it is. We're playing with money, what most call the root of all evil. The most stressful part about trading is watching how easily and fast money can disappear from your account when the trade is going against you. One day you will be quite content and pleased with the green profits across your screen, while the next day it might be a sea of red and everything you made yesterday, maybe everything you made over the past month, is gone in a flash. This is why it's so important to take profits while you still have them and cut your losses short before you lose too much, which we'll be going over later. Because in the stock market, sometimes just as easy as the profits came in, even faster and easier they will disappear. So it's important to know that the stock market isn't all glam, glory, fame, and fortune. There is always going to be stress involved, and statistically speaking, the odds are not in your favor that you will ever become a successful trader. But by the end of this DVD, it is my goal that the odds will be much higher in your favor once you understand what it takes to be successful in this game from my perspective as one of the few successful traders out there. As no day in the stock market is the same, I understand that this isn't no desk job where you come to work and you're on the same routine at the same job, same paperwork, same hourly rate, or same salary. Every day you have to react and adapt to the current market conditions and make decisions based on what's happening now as it comes. This makes every day in the stock market unique, which keeps the job and hunt for potential stock trades continually exciting. Alright, now this next section I like to call Fantasyland. So a very important thing you need to learn is that every day is not a winning day in the stock market. The life of a trader is filled with many successes as well as many failures. In trading, I go on hot streaks, cold streaks, or just kind of a mediocre in between where there's really just not that much action or trading opportunities going on in the market, making it difficult to make money. The hard part is learning to accept the losing streaks as part of the game. Even till this day, when I'm on a losing streak, a small part of me makes me feel discouraged and think to myself, what's going on? Am I losing my edge in the market? Nothing seems to be working. But overall, I've learned that this is just part of the game. Trading opportunities usually come in cycles of several weeks hot, several weeks cold or warm. A lot of people come and sign up for my website, and if I'm not on fire for their initial trial period as a member, then they might think, man, what a crappy service this is. But most customers don't know anything about the stock market, don't realize that not every week of the year you're making massive amounts of money. The goal is to take advantage of the hot streaks when you can and lock in your profits and cut your losses quickly when you're on a cold streak. Statistically, it is said that only around 10% of the traders out there do it successfully, leaving that other 90% to fall in ruin, lose their life savings, lose their homes, lives, or maybe they just lost a couple grand they had saved up. Obviously, losing any amount of money is not going to be fun. Many people come into the market with the naive notion that this is going to be easy. All you have to do is buy low and sell high, right? I always have people that are interested in the stock market come up to me and say ignorant things like, hey, check out ticker XYZ. It went from 3 to 15 in 2 weeks. We could have made so much money on that. How come you didn't buy that one? I have some money saved up. I think I'm going to get in the market. I just need to find the next stock that is going to make the same move like that one. If you're, if you're coming in the market with that kind of fantasy, you're already on the road to inevitable failure. I can only answer stupid questions like this so many times. You're never going to catch every opportunity, and more importantly, you're not going to consistently catch the bulk of every opportunity. So in reality, maybe I did buy that stock. Maybe I bought it at $3 and sold it at $4.10, which would have been an awesome trade. They might ask, it went all the way to $15. Why the hell did he sell it at $4.10? Well, there's no way I could predict the stock was going from 3 to 15. Sure, it's easy for some idiot to look at a stock chart and say, I could have bought it here and sold it there after the fact. But in all truth, that's just not how this game works in any way, shape, or form. As an active trader, you can't go into your trades expecting huge returns every time. In fact, expect that you might lose about 50% of the time, if not more. The only way you make money in this game is by taking your profits when you have them and cutting your loss short before you damage your portfolio extensively. Now, catching a stock from $3 to $15 is not impossible, but it's a fantasy that 99% of the time is not going to happen, especially in a short amount of time. Most people that are new to trading expect too much out of the trade, and instead of locking in a profit once the stock has gone up some, they keep holding, think that this stock is heading higher, Yet oftentimes the stock drops and they lost their profit. So you can't always be living in the fantasy world. Excuse me. You can't always be living in the fantasy world thinking you're going to score big every time. Take your profits and trades as they come and continue moving forward. Think of it like how a football team focuses on driving the football down the field with numerous strategic plays rather than tossing up high-risk Hail Marys every play. And if they're failing to reach the goal line to score points, then they cut their losses short and punt to defend themselves against further failure, or they settle for a field goal to ensure at least some points if they are in range. The reason you don't see football teams going for Hail Marys every play is because it's just flat out stupid, highly risky, and not a consistent way to have a long-term success in the season. Sure, they might get lucky and win a few games, but they will probably have a losing season overall. Basically, to sum up what I'm saying is that you can't come into the stock market with a hot head and think you're going to complete some Hail Marys and get rich quick. You need to play it cool and remain conservative and defensive, especially as an inexperienced new trader. Alright, so next section we're talking about hope is for losers. You just gotta take the loss. Okay, so many traders will buy a stock and watch as it rises to see the profits going up in their portfolio. Ecstatic with joy, they tell all their friends that their stock is up, they bought it at $5 and they think it's going to $10. Only instead of going to $10 per share, they watch as it jumps maybe up to $6.50. This would be an awesome short-term trade. And then twice as fast as it rose, it sinks below $5, placing them in a losing position. Now they're sitting there hoping it will come back up. Take note that stocks can fall about twice as fast as they rise. If I could tell you one thing right now to improve your success as a trader, it would be never to sit on a losing stock position hoping that it'll come back up. Once again, never sit on a losing position hoping that it'll come back up someday. Time and time again, I hear traders say that they bought a stock thinking it was going to skyrocket. Yet it keeps going down, and now they're in a huge losing position because they didn't use proper portfolio management tools and are now sitting on their sorry, I'm getting mixed up here. They're on the losing position because they didn't use proper portfolio management rules and now sitting on their position hoping it comes back up. Now this is just absolutely stupid. My motto is plan, execute, profit. Meaning that we first make a plan for the trade, we don't screw around, we execute the plan. And in turn, we either have a profit or we cut our losses short if the trade doesn't work out for us on the profitable end. Always have a breaking point in which you set a stop loss, meaning that if the stock goes below a certain price, you sell the stock and you walk away. If the stock comes back around and looks good, you can always rebuy it, but don't sit there like an idiot and watch your money dwindle as it continues to fall, hoping it will go back up. What people don't realize is how counterproductive it is to hold on to a losing position. When a stock is going against you, why would you want to keep holding it? It's apparent that the trade is not working out in your favor, being that you're losing money. So instead of sitting there with your stupid loss that may just keep getting bigger, you have a much greater chance of making your money back by selling the stock for a loss and trying to find a new stock that looks like a good trade. Holding on to a failed trade in hopes of it someday coming back up where you bought it is the dumbest thing I've ever heard. Now you're going to get stopped out a lot over the years when you wish you wouldn't have because the stock may have bounced back up shortly after you sold it. That's just the way it goes as a trader sometimes. But overall, you're going to run out of a lot of money real quick if you don't protect your capital and accept losses. Because sitting on a losing position hoping that it will come back up will lead to your inevitable failure in the future. I guarantee it. Okay, so moving on to the next section, by now you know that I've been talking a lot about emotionless trading. Although in reality, there's really no such thing as emotionless trading while you're trading as a human being. You're always going to feel emotion when you're in the trading seat and have open positions in the stock market. So really, all you can do is try to come up with ways to cope with these emotions and simplify your decision-making process so that you're not stuck in a brain fart when in the middle of a trade and not sure what to do. The best way to simplify your trading and cope with your emotions is to first and foremost set up a trading plan before you enter a trade. And as I had just mentioned, my trading motto is plan, execute, profit. By using a plan, this simplifies the question of what the hell am I supposed to do with this stock now that I'm in it? If you don't have a trading plan, then you're basically flying blind and just wandering the beaten path. You don't have a set proposal of how to protect yourself from losses or a goal to reach where you will lock in your profits. It's really just not a safe way to go about trading if you want to do it successfully. So later on in this presentation, I will teach you how to set up a trading plan in order to simplify the thought process of your trades and attempt to cut down on your flawed and inevitable human emotions. Okay, so next up we're going to talk a little bit about defensive trading. So each time you enter a trade, you need to be first thinking defensively. You need to think about how you're going to protect yourself from standing in excessive loss that will do some substantial damage to your portfolio if the trade goes sour. Of course, we are always shooting for the win whenever we enter a trade, but typically the stock market is not a greatly consistent being. My winning trade percentage is fairly close to being 50-50 of wins and losses. I don't know what the exact numbers are, but I'm probably pushing around a 60% win ratio, and this is me as a seasoned trader. It's likely going to be more difficult to have this kind of win-loss ratio as an inexperienced trader that really doesn't know what they're doing. So first thing you need to do when you enter a stock is figure out what price you will exit the trade if the stock goes against you and you need to cut your losses. Second thing you need to do is figure out what's your profit target. Yet you don't always need to have a profit target when you're in a position. It depends on the conditions of the trade and where resistance levels are, if any. If you don't have a price target that you were looking to take profits, then the only other means of the plan is trend following, meaning that you are either following some kind of trend indicator and are continuously moving your stop loss price up based on support levels as the stock continues to go in your direction. So, meaning that if you buy a stock at $9 and your stop is $8.75, if it moves to $9.25, let's say you move your stop up to $9 and so on, so that you're continuously raising your stop prices as the stock goes higher. In accordance with as the stock goes higher in accordance with various indicators such as patterns and support levels, thus guaranteeing some profit. A common term in the stock market is the trend is your friend, meaning that as long as the trend is in your favor, you should remain friends with the stock. But when the trend reverses, you need to part friendships with your stock and find a new friend. The way to know when to end your friendship with your stock is when the trend indicator that you are following, which is also your stop loss point, is breached. But I will be getting into the whole trend following stop loss jargon later in this DVD. Just remember that in trading, just as in sports, the best offense is a good defense. Okay, so now we're going to talk a little bit about the differences between buying and selling. So buying a stock is just as easy as clicking a few buttons. So is selling. Or is it? Psychologically, it's significantly harder to sell a stock than it is to buy a stock. When buying a stock, you're going to be nervous. Click the buy button. Okay, cool. I'm in and that was easy. I just bought this stock because I think it's going in a certain direction. But now that you own this stock, the fear and greed start to settle in. The stock is going to be moving up, down, sideways, or wherever the hell it wants to go. And you're going to have to sit there and watch it and decide what to do with it based on its movements and outside forces like news and broad market behavior. Unfortunately, when you first start trading, your emotions are going to be hard to control. If you find that you can't learn to control your emotions over time and remain disciplined and stick to your guns, then you're going to have a very time ever being a successful trader. Once you own a stock, there's always the question of when and where do I sell this thing? There isn't any right answer to this question, but I do have several answers to that question from my perspective as a trader that pertains to my portfolio management rules that we'll get into soon. The hardest thing for new traders to do is being disciplined enough to accept the loss and click that sell button. It comes back to the hope perspective on things, where you're too stubborn to sell the stock when it's moving against you, and instead of cutting your loss short, you continue to watch it fall. As you become members of trading communities, you're going to hear the term bag holder. This is a common term used for what I actually call retarded traders. No, they are not actually retarded, but they may as well be. A bag holder is someone that bought a stock at a certain price and never set a stop, or they are too stubborn to honor their stop position and continued holding when it kept falling, hoping that the stock comes back up, yet it never does. Now they are in a huge losing position where they feel it is pointless to even try to sell here at such a big loss, and they are praying that someday the stock goes back up, yet most of the time it never does. This is a very common situation for people who get sucked into the hype and manipulation of penny stocks, which is the riskiest game in the stock market. I get a lot of newbies asking me what I think they should do with some crappy stock that they bought a long time ago. Now they're down 60% on it because they are stupid enough to continue holding it through the collapse. I honestly don't have answers for what I think they should do if they're stuck in some crap stock that is down. My best answer is to learn from this mistake and don't let it happen again. As a trader, you are going to need to learn to accept taking losses and move on to the next trade so you don't do some significant damage to your portfolio. In addition to accept selling a stock for a loss, you need to learn to accept winners as well. Once someone is in a winning position, they become extremely greedy and never allow themselves to push that sell button and lock in their profit. In this game, the only way you ever make money is by pushing that sell button when you are in a winning position, and just accept the fact that you made money. Don't let the fantasy world of thinking that this stock is jumping 300% get in the way of you making an awesome 20% short-term gain. You should also learn to accept that if you planned a trade and executed that plan, yet even though it was a loss, it was a successful trade, being that you followed your trading plan and remained disciplined.
Okay, so now moving forward, we're going to talk a little bit about confidence and fear in your mental state while you're trading. So when you are at your trading desk, it is extremely important that you are in the right mental state. This is your money on the line here. You need to be thinking rationally and be confident in yourself to execute trades and stick to your trading plans. Many people who are first learning to trade come to the table trading in fear. They are so scared to lose money, thus are too nervous and don't think rationally when they are placing a trade. The first thing that sparks fear in you is when you are trading with money that you can't afford to lose. So if you are looking to throw your money in the stock market because this is your last dime and you're broke and you're looking for a get-rich-quick scheme, the stock market is probably not the wisest place you could be gambling your money, as trading pretty much is gambling. I guess I like to call it educated guessing, as you can factor in various criteria to base your decisions on. When you're comfortable with the money in your online broker, you feel a lot safer about placing trades, and you have some cushion so you don't freak out when you make some losing trades and you're watching your account fall. Your portfolio is never going straight up, it's going up and down, up and down. Yet hopefully, if you are successful, then you are progressively making higher lows and higher highs as your account trends up in profitability. Next up, we're going to talk a little bit about revenge trading. So trading in fear typically leads to an unprofitable trader who can't seem to take his head out of his own ass and think rationally. Once the losses start pouring in, this can many times lead to a chain reaction of bigger and bigger losses, which is usually a result of revenge trading. Revenge trading is usually what takes a trader to his final moments of death. Revenge trading is when you suffer losses from many or maybe just a couple trades that have done some real damage to your portfolio. So in order to make that money back quickly, some people rationalize that they should swing for the fences and bet big on one or a couple of high-risk stocks, hoping that they hit the jackpot and make their money back quickly. Think of it this way. Say you fell into a ditch and there's only two ways to get out of this thing. First, you see a pile of equipment and materials that will construct a ladder that will likely get you out of this ditch safely. Yet this is going to take a lot of time, patience, focus, and discipline to figure out how to build this ladder and climb out of the ditch. Next to this, there is a rocket jetpack that you can strap on and fly out of here in the next 5 minutes. Yet, there's a warning that says, use of this jetpack may result in your death or serious injury. Many people are so desperate to make their money back quickly that they choose to strap on that jetpack and hope that they finally make it out alive. But only a very small percentage of people who strap on that jetpack ever make it out of this ditch safely. So don't be an idiot and bet that you are going to be one of them. A large percentage will fail to use that jetpack safely and fall back down in the ditch and break their leg, making it twice as hard now to go the safe route and build the ladder and get out. The dumbest of the dumb percentage will continue to use the jetpack until they finally die. Or they will be so seriously injured that they will have some serious work ahead of them if they finally decide to try and build that ladder. So basically, some people are stupid enough to make high-risk trades after they are already down in their portfolio in a desperate effort to make up for their losses. The problem is that if you don't come out on top, you could suffer some more serious losses that will eventually dig your own grave. And in this game, especially as a beginner, your first goal should be learn how to survive. After you figure that out, your new goal can to be start making money. Okay, so now we're going to talk a little bit about playing the field or diversifying versus overtrading. So another serious problem that traders face that results in significant losses is when they're overtrading. Overtrading is when you consistently make numerous trades that are not ideal setups. Basically, you are trading out of boredom and are not being patient and disciplined enough to wait for the most ideal and consistent setups. It is so important that you remain disciplined enough to wait for the right and consistent trading setups to come to you rather than settling for half-assed trade setups just because you are bored and want to trade something. This brings us back to the whole confidence aspect of trading. When I'm scanning for stocks to trade, one stock will all of a sudden stand out above the rest, and I'll literally feel it in my gut, which makes me confident that this is an ideal trading setup. This is what I've been waiting for, let's make this trade. When you second guess a trade and you're sitting there thinking, this one looks semi-okay, I'll give it a shot and let's see if this works out. This is when you need to make a mental note that you might be overtrading. But you probably wouldn't even need to make note of it because of all the losses that start pouring in because you're making stupid trades. From here, if you begin to notice the signs and consequences of overtrading, it's up to you to take a couple deep breaths and remember that you need to be waiting for the best trading setups, and that you literally need to feel it in your gut that this is the right trade when it presents itself to you. No second guessing yourself. So opposite of overtrading is playing the field, or diversification. Basically, diversifying your portfolio is your key to success. It is very important that you do play the field and trade numerous stocks in your portfolio, as when you're trading, even trading the right setups doesn't mean you will win every time. Ideal setups can constantly be false breakouts or breakdowns and turn out to be losing trades, as the market is not a perfect world. So it is important that you do trade among the majority of the ideal setups that you come across in order to be able to catch the moves on the ones that do work out, rather than just trying to play one stock at a time and hoping that this is the one that's going to make you money. That's the whole reason why I am able to win in the stock market, is because my portfolio is diversified among multiple breakouts that are currently in play. This enables me to catch big moves on the trades that it enables me to catch the big moves on the trades that work out and cut the losses short on the ones that aren't working. But to the point again, remember that there is a huge difference between playing the field and the stupid mistake of overtrading non-ideal setups. You must feel it in your gut and be confident that this is the trade I've been waiting for on any given trade you make. So basically, to sum things up, the main point of this whole section on trading psychology is to inform you that it's extremely important to remember that a disciplined and confident trader is a happy trader. The goal of your mental psyche is to be able to think rationally at all times. Remember to set up trading plans for every trade that you make so that you can simplify it as much as possible, thus relieving stress levels and avoiding confusion about what you should be doing with your position while you are in the middle of a trade. So up next, we're going to talk about fundamental analysis and look over some of the key financial jargon that you need to know as a trader. Fundamental analysis is the study of the internal financials and operations of a company with the goal of deriving a theoretical valuation of the company. Now, fundamental analysis is not a must-have as a technical-based swing trader, but it can definitely be beneficial when the fundamentals of a stock can back up the technical aspect of the trade. So I highly recommend using a combination of both fundamental and technical analysis when making your decisions in trading. So let's look at some of the basics behind the fundamentals and learn some of the key terms about stocks. Also take note that I am a technical analysis based swing trader, so I'm only going to be going over some very basic, simple things. If you want to actually learn a lot about fundamental analysis and the internal workings of a company, then I would suggest reading a book on the topic. So first up is shares outstanding.
Shares outstanding is the total amount of shares that the company has that are held by all investors. This includes restricted shares, which can only be owned by company officers and insiders, and then there is the shares held by the public investors and traders. The float is the amount of shares that are available to trade on the open market to the public, which is us. The float is calculated by subtracting the restricted shares from the outstanding shares. Stocks that have low floats are typically very volatile and can make big moves to the upside or downside because it doesn't take a lot of people and money to buy into the stock to influence price action. Market cap is referred to as the company's total real valuation based on the stock's share price in outstanding shares. So to get the market cap of a stock, you would multiply a stock's share price by its total outstanding shares. Depending on the stock's market cap, it can be ranked in different categories. I generally only trade stocks that are in the mid to microcap range. These are smaller companies, usually under $20 per share, and can make significant price movements in which we can capitalize on short-term gains. So the market cap rankings are listed as this. There's the mega cap, which has a market cap of $200 billion or greater. Large cap is $10 billion or greater. Mid cap is $2 billion to $10 billion. Small cap is $300 million to $2 billion. Micro cap is $50 million to $300 million, and nano cap is under $50 million valuation. So many people who are new to the market think that just because a stock's price is higher than the other, then that company is worth more or maybe a better stock. Yet this is not true by any means. The number of outstanding shares varies greatly from company to company, which determines what the company's market cap is. So for example, let's say that stock XYZ is trading at $20 per share and it has 10 million shares outstanding. So the market cap would be $20 per share times 10 million shares outstanding equals a market cap of $200 million. Now let's compare that to stock ABC, which is trading at just $10 per share, yet this stock has 50 million shares outstanding. So the market cap of stock ABC would be $10 per share times 50 million shares outstanding, which is a $500 million market cap. So while stock ABC is trading at half the price of XYZ, its actual company value is worth more than double based on its market cap. To put it in another perspective, let's say Google was looking to buy out either stock XYZ or ABC. In order to buy out stock ABC, then they would have to make an offer at or around $500 million because that's what the stock is currently worth based on its market cap. Well, if they were to make an offer to buy out stock XYZ, then they would have to make an offer at or around the market cap valuation of $200 million. So company ABC is essentially worth more than double than that of XYZ, even though it's trading at half its share price. Excuse me. Next up is something you've probably heard of before, and that's earnings per share, or EPS for short. The EPS is how much net profit a company makes per share outstanding minus paid dividends. So to calculate a company's EPS, you would deduct the amount of paid dividends from the company's net income and then divide this number by the company's outstanding shares. So for example, let's see company XYZ had $50 million in net income in 2010, paid $2 million in dividends to their investors, and had an average number of shares outstanding for the year of 100 million. The EPS would then be equal to $50 million net income minus the paid dividends of $2 million divided by 100 million shares outstanding, which equals 0.48. So this would mean that the company XYZ made 48 cents per every share outstanding in 2010. You use the average amount of outstanding shares because the company's outstanding shares can vary from quarter to quarter due to dilution and share buyback programs, which we'll be going over this next. So every company has the right to issue new shares of their stock to the public and increase the number of outstanding shares on the open market, or they can buy back shares from the public and decrease the amount of outstanding shares on the open market. So dilution is when a company issues new stock to the public for sale in order to raise funding for the company. Companies do this for several reasons. One is that they can raise money for the company by the sale of their stock rather than borrowing money and paying interest on the loan. Another is that they are raising money so they can expand their business further. And last but certainly not least, it's because they need money just to survive. Dilution is often seen as a negative for the company for several reasons. Usually, once a company announces that they are issuing new shares on the open market, their stock can see a quick and heavy drop in price. Now, if the company was successful and very profitable, then it would likely have enough cash on hand to pay for whatever kind of expansion they wanted to do. So when a company has to issue new shares to the public to get money for their expansion, it is seen as a weakness. In fact, investors don't typically like this and sometimes tend to sell. Another negative impact of dilution is that it also decreases shareholder value. So let's say, for example, Mark owns 100,000 shares of company XYZ, and the company currently has 1 million shares outstanding. Thus, Mark would own 10% of the company's total outstanding shares. But then the company decides it wants to issue another 1 million shares to the public because they're looking at long-term growth and need the extra money to expand their business. While this could be a good decision for the long term, in the short term it decreases shareholders' value. Now Mark only owns 5% of the company with his 100,000 shares rather than 10%, being that the outstanding shares have been diluted and there are now 2 million shares outstanding rather than 1 million. Dilution also affects the company's EPS by increasing the supply of shares on the open market, which can affect its EPS growth. So let's say, for example, company XYZ had $50 million net income in 2010, paid $2 million in dividends, and had average shares outstanding of 100 million. So then the EPS would be 50 million minus 2 million dividends divided by the 100 million shares outstanding. This equals 0.48. Now let's see these numbers, say if the company issued 50 million more shares to the open market. Then the EPS would be the $50 million net income minus the $2 million paid dividends divided by 150 million shares outstanding equals 0.32 EPS. So when issuing more shares to the market, this can stunt the growth of a company's EPS. Although this doesn't mean that the company will earn less money in the future, it just means that the company will earn less money on a per share basis as the number of outstanding shares increases, which looks bad on paper. As well, a company that is frequently issuing shares to the open market is likely not in good health and will have a hard time getting a steady rise in their share price. Now, on the opposite side of dilution, a company can do something to further increase shareholders' value, and that's when a company announces a share buyback program. A share buyback program is when a company reinvests its free cash flow back into itself by buying back shares of the stock on the open market. When they do this, the number of outstanding shares decreases and it also increases shareholders' value. So let's say, for example, Mark owns 100,000 shares of company XYZ, and there are currently 1 million shares outstanding. So Mark would then own 10% of the company's shares. Yet if the company announced a share buyback program and decided to buy back 500,000 shares of the company, then Mark's initial 100,000 share investment is now worth 20% of the company, thus making his share of the company more significant. Share buyback programs also decrease the supply of the stock, thus increasing the demand for it. This usually results in a stock's price moving up rather than down, simply for the fact that the demand is increased. As when a company can afford to buy back shares of their own company, this is a sign that the company is very healthy and investors are attracted to buying into the stock. Companies also do this because they think that their company is undervalued, and in hopes of the stock price continuing to rise, they can later sell the shares back on the open market at a higher price than what they bought it for in the first place. So basically, overall, share buyback programs are a very positive thing and can lead to higher stock prices. Now digging deeper into financials and using the EPS to calculate another value comes the price to earnings ratio, which is also known as the PE. The price to earnings ratio calculates the valuation of a company's current share price in comparison to its earnings per share. Other terms you might hear are earnings multiple or trailing PE, of all which mean the same thing. So for example, let's say that company XYZ reported earnings of 1.34 earnings per share in the past 4 quarters and is currently trading at $15 per share. The PE would then be calculated by taking the $15 per share and dividing it by the 1.34 EPS. So the company's price to earnings ratio is currently at 11.19 times earnings. Now there's several reasons of why price to earnings ratio is important to know, so let's go over the few of them. First off, the PE is one of the most important fundamental comparison tools because it allows you to get an idea of how well a company can report profits in comparison to one of its competitors or to the stock's industry as a whole. It also gives you an idea of what companies are overvalued and undervalued in their industry based on their share price and EPS. So for example, let's say that stock XYZ is a software company and it currently has a price to earnings ratio of 10, while the software industry average PE multiple is 18. Stock XYZ would then theoretically be undervalued within its industry, being that it is trading below the current industry average price to earnings ratio, whereas a stock trading above the industry average of 18 would be considered overvalued. So basically, the lower PE stocks you can find, the better, as they are considered to be more undervalued and may be looked at by people as cheap stocks that have a good chance of going higher. It's also important to note that the normal price to earnings ratio, or trailing PE, is based off of past earnings. Past earnings are typically already discounted into the stock's current share price, so this theoretically has no influence on the stock's future share price. To speculate on the stock's future share prices, we need to then look into the estimated future earnings, which is known as the forward price to earnings ratio. The forward price to earnings ratio is the valuation of a company's current share price in comparison to its forecasted earnings per share in the following year. These numbers are just educated guesses as no one can predict the future, but they are numbers that give us a look at the company's future potential and where share prices might head. The estimates of the forward earnings are typically created by market analysts or the company itself. Calculating the forward earnings PE ratio is just as simple as the normal PE ratio, yet instead of dividing the share price by past earnings, you divide it by estimated future earnings. So for example, let's say that analysts are expecting that company XYZ will report EPS of 1.25 for the year ahead of 2010, while this year they have reported EPS of 0.75. The current share price of XYZ is $10. So the trailing PE would be 10 divided by 0.75 equals 13.3 times earnings, while the forward PE would be 10 divided by 1.25, or just 8 times earnings. So this means that the company is obviously expected to grow as the forward earnings ratio is lower than the current PE ratio, which would entail that the company's share price may possibly go higher from here. This brings us now to the future fair value, or FFV for short. The FFV is the estimated future share value based on the industry average PE ratio and the individual stock's forward earnings estimates. It is calculated by multiplying the industry average PE by the company's forward earnings estimates. Over the year, I've found that stocks that have attractive FFVs, along with bullish foos patterns, have been some of my most successful trades. Stocks that have future fair values of 1 to 5 times its current share price are considered fairly attractive to me. Also take note that just because a stock's FFV says it could double from its current share price does not by any means guarantee that the stock will do so. The FFV is not a tool to be used as a target price of where you want to sell the stock. It's basically a tool to use to see if the company is expecting some large growth into the future that we can speculate on. The thing about the future fair value is that it's all based on the hype and speculation. No one really knows what a stock's EPS is going to be next year, but if a bunch of analysts come out and say that they think this company is going to have significant growth and dishes out strong forward EPS estimates, then this creates hype and high FFV values in which we can trade off of. So let's take a look at an example of a stock with an attractive future fair value that was coupled with a strong stock chart. So here we have Dana Holding Corporation, ticker DAN. This is a snapshot from Yahoo Finance on June 10th, 2009. Basically, all you would need to do here is go to yahoofinance.com, type in DAN to the quotes section. Obviously these numbers are changed now as it's 2010 now, and this snapshot is from 2009. But you would click the Analyst Estimates tab under the Analyst Coverage area and take the average estimate for the forward year, which in this case is 0.45. From here, you would then need to get the industry that the Dan is trading in and get that industry average PE ratio. This is under the company section under the competitors link, and you would go to the industry, find the PE average, which is 17.49. So now looking at the current stock chart, the stock is around $1.50 per share. Looking forward, the analyst estimates are for the forward year are 0.45 EPS. The industry average price to earnings ratio is 17.49. So to get the future fair value, you multiply the future estimates by the industry average PE. So that's 0.45 EPS times the 17.49 industry average price to earnings ratio, which is a share price of $7.87. So down here at $1.50, and this stock has a future fair value of $7.87 at its current share price, this is looking fairly attractive and deeply undervalued. Along with this bullish stock chart looking like it's going to rebound, excuse me, coupled with a future fair value, this is a highly potent, trade setup here. So now let's look forward. Now it's October 8th, 2009. Then if we look at the current EPS estimates now, up on October 9th, it has changed to 0.25, and the industry average PE ratio is now 31.91. So now looking at these numbers, we can calculate what kind of future fair value it has from the current day, and also let's take a look at what has happened to price action over the past several months. So looking here now, we're looking at this stock down at $1.50 when it had a future fair value of $7.84. So that was looking highly attractive. Looking to current day, the stock is trading almost at $7 per share. So it actually rose up near its future fair value that was calculated when we did it down here at $1.50. So back then at $1.50, the stock had a very attractive FFV. But looking at today, when the stock price is currently $6.74, the forward analyst estimates are 0.25, and the industry average PE ratio is 31.91. It has a future fair value of $7.97. So the stock is almost up in these levels already. So this is just an example of showing of when a stock does have a future fair value that's attractive, and then showing a stock when it's trading at or around its current future fair value. Which indicates that maybe this stock doesn't have that much more upside potential. This is just all based on, we're talking about fundamentals here. So, if a stock breaks out, even though it doesn't have a very attractive future fair value, that that doesn't mean at all that it's not going to make any continuation based on the chart alone. This is just an example of a tool that I use to back up a stock that has a nice technical chart, a way to back it up with some sort of tech or fundamental analysis in addition to that. Going forward here, I just wanted to look at an example of another stock with an attractive future fair value. This is we're at stockcharts.com looking at this. This is another small bank, Independent Bank Corp, IBCP. It's January 4th, 2011 today. Just looking here, the stock is very depressed in price action. It's gotten beaten way down, off the highs up here not too long ago, up in the 20s. Now we are all the way down, and it dropped to a low of about $1. Then we recently had this huge volume coming in here, so there's definitely some kind of buying interest here. Then if you go and look, let's take a look and see what the future fair value is here. If we go down here, check the analyst estimates. This year they are not looking good. They reported 1.84 for 2010. Coming up in 2011,
An analyst is expecting 1.19 earnings per share. Who knows if this is real or not? These estimates, nobody knows what's going to happen, but this does create hype, and a lot of people come here and look at this. So then we could go here and check out the competitors tab, see what the industry average PE ratio is at, which is 17.29. So looking here, if we multiply the 17.29 industry average times the 1.19 expected forward earnings, that gives us a share price or a future fair value of $20.57, which is extremely attractive from an FFE value. So, I have not looked into this company whatsoever. I don't know if they're on the verge of bankruptcy or anything, but just looking at it from a technical perspective, with this volume coming in here, building a nice base, and the chart's looking like it's on the verge of a possible rebound, plus the extremely attractive future fair value all the way up at $20. This looks like it could be a very solid trade. So that's just another example of stock with a strong FFV value. Okay, now we're just going to talk a little bit about technical analysis. So technical analysis is the study of price action. Basically, it's a study of looking at the past of what stocks have done, analyzing it, and then you use that to project or forecast what you think a stock might do in the future based on what it's done in the past. I'm just going to give a very basic rundown of this stuff. I highly recommend you read a book on technical analysis. People write 400 pages on this whole topic. I'm going to just do a simple crash course on support and resistance and a couple chart patterns, in about 10 minutes. So I'm not going to go deep into technical analysis. This is just really basic stuff I'm going to be talking about just to kind of update your vocab if you don't know what any of this stuff is. So moving forward, first we're going to talk about support. Support is the level at which point the demand for a stock is believed to be heavier than its supply, meaning that as a stock price declines to a support level, more buyers are willing to buy at these prices, which prevent this stock from declining further. Support is established by the relative lows of a stock's price over the course of time. If a stock drops to $5 per share, then rises back to $6 per share, if it then declines again to $5 later, then $5 could be considered a support area, being that in the past the demand for this stock at this price caused it to stop falling. Basically, that's what we're looking at in this illustration here. Here's a stock, say it was just riding along, and then it came down to $5 and then decided to bounce off that level. It rose again, say back up to $6 per share. Once it starts falling again, according to the past, people found that there's a strong demand at $5. So moving forward, as that's what we're doing, we're projecting what a stock might do in the future based on its past history. That we could forecast that maybe there might be a strong demand for this stock to buy at $5 per share. So that's it's kind of a self-fulfilling prophecy following technical analysis, and that's what happens. It will probably bounce at $5 per share. But there's also the chance that support levels don't always hold, and the increased supply or selling pressure in the stock can lead to a breakdown of the support level. Thus, the supply has overtaken power of demand, and the stock's price will likely decline as the buyers have dried up and sellers to continue to take control. So that's basically what we're looking at here in this illustration. Basically, to form support or resistance, you want at least two reaction points. So you can see here we got this first reaction point, then this second reaction point. Now we have a strong support level formed. Now, if that level is breached, that's a pretty big indication that the buyers at this level have all dried up, and there's just an increased selling pressure in supply, and that this might be a sign that the stock will continue falling below this $5 level rather than bouncing from it. So opposite of support is what's called resistance. So resistance is the level at which point the supply or sellers for a stock is believed to be heavier than its demand, meaning that as a stock price rises to a resistance level, more sellers are willing to sell at these prices, which prevent the stock from rising further. Resistance is established by the relative highs of a stock's price over the course of time. So say a stock rises to $6 per share and then falls back to $5 per share. If it rises up again to $6 later, then the $6 area could be considered a resistance area, being that in the past the supply or sellers for this stock at this price caused it to stop rising. Just the same exact thing. In this illustration, if a stock price rises, it finally peaks out at a certain level. So moving forward, if the stock price rises back to that level that it peaked out in the past, that could be an indication of an area where more sellers might come in. So if it has two reaction points there, that creates a very a significant level where in the future you can expect that it would be hard for the stock to breach that level. On the opposite end, if it breaks that established resistance and moves above that $6 level, that's an indication that the buyers have finally overtaken the sellers at this level, and that this is a buy signal, and that it indicates that the stock price could continue rising up above this level. Up next is uptrends and downtrends. This is basically the same exact concept, but what we were talking about just now is kind of stocks moving in a sideways or horizontal manner. Uptrends is basically just looking at support and resistance, or uptrends and downtrends is basically looking at support and resistance, and just in stocks that are moving up or down. So an uptrend which is commonly termed as a bull trend or ascending trend, occurs when stock's price is sustained by continuation of higher prices as time progresses, meaning that as the price rises and time progresses, there's still a high demand for the stock as at its current and rising share price. An uptrend line can be drawn by connecting 2 points or more of price action. This is done so by connecting each higher low. In an uptrend, as price retests the trendline support, the demand increases, as this is where new buyers come in. As long as price stays above the ascending trendline, then it is considered that the stock is still bullish and still has a high demand. If price drops below the ascending trend line, then it is very possible that the trend is over and may begin moving in the opposite direction, as there is no longer a high demand to sustain higher prices. So it's just a basic, simple illustration here. You want to see at least 2 reaction points or more where you can connect ascending trend line, and as long as it stays above that trend line that you have drawn, it's considered bullish. But if it breaks down that trend line, it's considered that the demand for this trend may be dried up, and the sellers might take over and reverse where the direction of the stock. It's the same exact thing for downtrends. A stock that is falling, if you can connect relative highs of its declining price, then you can form what a downtrend or descending trend line to follow. If the stock breaks out above the descending trend line, then it's an indication that there's no longer a very big supply, and the stock has fallen so much that no more people are willing to sell, and buyers may come in, and if it breaks above that trend line, then it might create a bunch of demand for the stock now and reverse the trend.